What up, Hyperchange? Welcome to another episode. Today we are doing a recap of Netflix's Q4 2017 earnings, which were reported earlier this week. The results were way above the company's internal guidance and Wall Street expectations. This sent the stock soaring to all-time highs above $250 per share. That pushed Netflix's market capitalization to $110 billion, an all-time high. So let's unpack these numbers and see why Wall Street was so stoked. The headline is revenue produced in the quarter, which came in at $3.3 billion, up 33%. This was an acceleration of 30% growth from the previous quarter. I mean, if you take a look at this historical track record of quarterly revenue, Netflix has just been consistently growing, and that growth is even accelerating. If you take a look at what they're forecasting for Q1 2018 as well, they're projecting $3.7 billion in revenue, which is up 40%. So they expect growth to accelerate even further in 2018. A big part of this is because they've been hiking the prices for their monthly subscription for their streaming service. This is a bigger part of the core Netflix thesis, which I believe they are underpricing their service and they're giving you way more value than you're actually paying for. This is going to allow them to hike their prices consistently over the next 5 to 10 years with very little churn. Beyond raising prices, the other huge driver of this growth is they're adding more members than ever before. The business isn't showing any signs of maturity. Additionally, from a profitability standpoint, EBIT or operating income for the quarter was $245 million, up a huge amount from $154 million in Q4 2016. And for the full year, they did about $839 million in operating income. This was up from about $380 million in 2016. So over 100% growth in their operating income this year. In the beginning of 2017, they had guided for 7% operating income margins. They hit that with about 7.2% for the full year. And what I think is really driving the stock to new all-time highs is their guidance for in 2018 to hit 10% EBIT margins. Netflix's core profitability looks to be scaling really quickly as they continue to grow. But there's also an interesting caveat here, which is although their operating income is positive, Netflix as a whole is actually burning a ton of money. What's really going on here is that the company is spending a ton of money up front to produce original content. They then amortize the cost of that original content on their income statement over the life of that show. For instance, if they spend $50 million to make The Crown, they got to pay that all up front, but then they put out The Crown and people are watching it and they're generating value from that for years to come. And so that's why they expense it over time. So Netflix is kind of a quirky business model in that sense. The free cash flow for 2017, because of this strategy, was negative $2 billion. A huge discrepancy from the $839 million they reported in positive operating income. In 2018, this trend's only going to continue. The gap's only going to widen. They're expecting to lose $3 to $4 billion in free cash flow. That's right, negative $3 to $4 billion. They're just going to keep pumping money into original content. I mean, they don't really have a choice here. Amazon's upping their budget. Disney is upping their budget as they get ready to go over the top streaming and compete with Netflix directly. It's now or never. They got to build their moat. They got to invest in original content. I think that's the right strategy, and it seems to have been paying off. In the letter, you point out a couple different things. Netflix Originals had 3 of the top 5 most globally Googled shows of 2017. That's a huge accomplishment. And what's even funnier is they did the same thing in 2016. They have found the magic formula for their content, and they are doubling down on this. In the letter, they say they want to self-produce content more and more. This means vertically integrate. Originally, it was sort of like, oh, we'll pitch this to a studio and pay them $15 million and they'll make the show and then we'll buy the exclusive rights. Well, now they actually want to produce the show themselves. I think this is really smart. It's going to cost more money, but it gives them more control over everything. Here's even a direct quote. In Q4, we signed overall deals with Stranger Things producer Sean Levy, Orange is the New Black, and Glow creator Jenji Kohan. Our goal is to work directly with the best talent to bring amazing stories to our members all over the globe. Longer term, I put out a video about what I think Netflix is going to look like in 10 years, Netflix in 2028. This is all predicated on their original content strategy. I think they're going to be able to monetize their content and these fictional characters and fictional worlds into merchandise, which they're actually already selling Stranger Things merchandise, and eventually into real world, VR experiences and sort of theme parks. Think Disneyland, but Netflix's own version. These are all avenues of growth and expansion for the company in the long term. And on a broader sense, this is why Netflix is so hard to value. You'll read in the paper that they have an astronomical PE ratio, which is true, astronomical price sales ratio, which is true, but those are all numbers that you're looking at the rearview mirror in. They are laying the groundwork to be a much bigger company in the long term. As I said, I even think they're massively underpricing their core streaming service. So if you look at what the revenue that's generating today, it's a massive low estimate to the actual value value that's providing. So as a company, 110 billion, I actually think is a very fair valuation for Netflix. For 2018, I am projecting about $15.7 or $16 billion in revenue for Netflix. That would be up about 35% from 2017. Based on their operating income guidance of about 10% EBIT margins, that's about $1.6 billion in operating income in 2018. Based on a market capitalization of 110 billion, where they're trading at today, that puts the 2018 price sales multiple at about 6.8, 6.9x based on my expectations. In terms of price EBIT, I'm looking at about 69 times price earnings ratio or P/EBIT ratio. So, these are really expensive multiples, but I just think Netflix is growing. They're investing heavily for the long term. They are going to continue to compound earnings at 50% plus, continue to compound revenue at 30% plus for the next couple years. And that's what the market's pricing in. Netflix is firing on all cylinders. Their bet on original content looks to really be paying off. I'd love to know what you guys think in the comments. Let me know. Are you bullish on Netflix after this move up? Anyway, this is Hyperchange. I will see you guys next time. Peace.